Okay, good. So there's enough people now. Thank you for joining. So today we're going to go through um, Sukuk and how it has very strong elements of Riba present, and I will use a live Sukuk transaction and prospectus to show the detailed structure of a Sukuk and how it works. So, um, okay, let's go through this. It's how long will it last? Maybe an hour, give or take. And if I finish before the hour, um, please, hopefully there'll be time for questions. I mean, if you want to ask a question while it's, when I mean ask a question, I mean in chat, because you'll all be muted. So feel free to ask in chat as I'm going along. If the question is, if it's not going to disrupt what I'm saying, I'll answer it then. If it is going to disrupt it, then maybe I'll answer it at the end. Okay, so these are the contents. And I just want to check the sound is okay, right? Because I can hear a bit of an echo on my side. So could you just say if the sound's okay or if you're hearing an echo? Sound is good, thank you. Okay. Okay, so here's the content. So I realize some of you might have some knowledge of Islamic finance and you might know what Sukuk are, but a number of you will not. So I'm just going to introduce Sukuk. And to do that, I have to introduce bonds. I have to say what bonds are. Okay, so I'll be quite brief, but I'll introduce what bonds are. Then I'll compare Sukuk versus bonds. So at least how the theory presents it. So if you Google anything about Sukuk and bonds, you'll get standard answers about what the differences are. And if you ask anybody, I don't know if anybody have attended training or maybe at university or something, or training classes on Islamic finance. This is what you'll be told about Sukuks, and this is all theory. And then we will look at a live Sukuk transaction. We'll go over some key questions that we want to address, and we'll go through the documentation to find the answers. And we will find out that virtually everything you're told about Sukuk is wrong. And then I'll address what this means. And I will talk a bit about AAOIFI, which is the standard setting body. Well, it's the major one globally, I would say, and the matter of assets in Sukuk and Islamic finance in general. And then I'll address why Sukuk is important, that, what we talk about is actually, it's meaningful. Sukuk is not just a peripheral part of Islamic finance. And then we could talk about some ideas about going forward, how things can improve. Okay, so I'll be doing some writing as well on the whiteboard, because I find that much more dynamic, but I do have these slides prepared. Okay, so in order to understand Sukuk, we have to know what bonds are. So bonds are quite simple instruments, but it's good to just go through the basics of them. Bonds are debt instruments. It's an IOU. In general, they're issued by corporates and by governments. And the key elements of a bond will be the size, the issue size, or the face value, or the nominal value. These are all different terminology for the same thing. The duration in years. Now, bonds and Sukuk, then they don't tend to be short term, though you can get some, but they tend to be 3 years and longer. And that's because of generally the complexity and the cost of creating them, that in general, it doesn't make sense to do it for 1 or 2 years, because the cost incurred and the legal cost, documentation is significant. I mean, for Sukuk, just the legal cost of creating documentation is around about half $500,000. So in order to do that and make it viable, you need two things. You need a significant size. This is why often you won't see Sukuk, around about $10 million is very small. Even $50 million is quite small. And certainly the ones I worked on, there were, $100 million, up to $1 billion. I think the largest one is still maybe $3 billion. And the duration needs to be three years or more. Normally 3 to 7 years is common for bonds and Sukuk. And then you get a coupon. The coupon is the interest rate. It can be fixed or floating, it doesn't matter. And the coupon, it can be annual. Annual is quite common, but it could be quarterly or semi-annual, or even monthly. Monthly is a bit unusual. But these are the things that define a bond. Without any of these, you don't really have a bond. Okay, so bond is simply a loan that pays interest. And this is riba. I mean, riba is much wider than interest, and riba is a fascinating topic, but it's not in the scope of today's webinar. But interest is generally accepted to be riba. There is some dissent, but it's a very minority view. So interest is riba. And bonds play a significant role in the financial markets. They are a huge asset class. It's bigger than stocks. And the reason they're important is they enable the issuers to raise money and enables investors to earn relatively safe returns. And issuers, with the coupons being fixed and the duration, well, when I say fixed, I mean they're known. They could be fixed or floating, but they're known. And the duration is known. It enables the issuers to budget as well and forecast. So these are very popular financial instruments. So here, this is it shows risk and reward. So volatility is a measure of risk, and this shows the expected return on this scale. So we can see bonds tend to be in the bottom left-hand corner. So treasuries are bonds. The only thing that's lower risk in general than bonds is cash and deposits, and you get a lower return. So bonds are around about here. These are all bonds. Some corporate bonds, as you go further down the yield curve, which means to the right, and they're slightly lower credit risk, then you'll get higher returns. And we see gold here, and leveraged buyout private equity, that has some of the highest returns. We have DM, I guess they mean developed market equities, and you have emerging market equities and commodities. So you can see that as you get into equities and as you get to emerging markets, you go to the top right-hand side, higher risk, higher reward, and bonds tend to be quite conservative financial instruments. So these are, the reason I'm showing this is that bonds are a crucial part of a portfolio, because you don't want, I mean, not everybody will just want an aggressive and a risky portfolio. So here's an illustration. So what I want to show here is that, so green is bonds. So I just want to look quickly at the returns of volatility for a conservative portfolio, which this estimates 50% should be in bonds, against an aggressive one where only 15% is in bonds and 60% US stock, 25% foreign stock. So if you look at the average annual return, bonds are lower, 5% compared to 9%, which is what we expect. And the best 12-month return, 31% against 136%, right? So they are lower, but they're not bad. And what offsets this lower risk is what offsets the lower return is a lower risk, right? So if you look at the worst 12-month return, it's 17% in this conservative portfolio and 60% in this aggressive portfolio. And if you look at the best 20-year annualized return, 11% versus 16, it's difference, but not a huge difference. And so the point to be made is, in a portfolio where you want relatively conservative diversification, that will have a heavy weighting in bonds. So bonds are crucial to the financial markets, to investors. And this is an indication of the relative size of the markets. Okay, sorry, people are still joining, so just sometimes I'll pause for a couple of seconds. Okay, so you can see the gray is the bond market, and you can see it's 2 or 3 times bigger than the stock market. So on a global scale, it's the largest asset class in the world. And then we have the US bond market, which is the largest for a country, it's the largest bond market in the world. And then there's Canadian. So I assume them. So the source is the Bank of International Settlements. So I don't know why they put Canada, maybe it's for a Canadian market. But you can see overall in the global asset classes, bonds dominate the asset classes. So I just want to get the message across that it's a serious asset class. Right, so this is why Sukuk were created, because there's a need for them. Investors need them and issuers need them. And so the question is, bonds are built on interest. Without interest, they cannot exist. And so how can we create Sukuk which are to fill the same place as bonds, but still keep the economic basis of a bond? And how do we do that and avoid riba, when riba is the building block, the whole reason for existence of bonds? So we must use assets. Islamic finance always use some kind of assets, and we will build a Sukuk structure around them. So a Sukuk should keep the main economic aspect of a bond, meaning, so there are 4 key things. The investor investors will deliver the funds to the issuer. The issuer pays regular interest payments. So these are the aspects of a bond. Interest is not permissible, of course, but these are the economic features of a bond that have to be, as much as possible, they have to be replicated. And the third one, issuer repays the capital at maturity. And it has to be the capital. It's a loan, right? So you can't repay 90% of it or 150% of it. You've got to repay the face value of the loan. And the risk the investors take is the credit risk of the issuer. And this is why bonds are often rated, and you'll see them from AAA, the highest rated. So some governments are AAA, down to triple B is generally seen as the lowest rating for investment class. And when you get to C and below, the terminology is junk bonds. But it doesn't mean they're bad risk, it just means the lower risk. But what this risk is effectively, it's the ability of the issuer to meet the obligations in the bond. So it's the ability to make the interest payments and to make the redemption at face value at maturity. This is the risk the investors want. They don't want risk to anything else. This is what investors want in a bond. So when we create a Sukuk, it has to have these similar characteristics. Okay, so here's some basic illustration of cash flows of a bond. So if you're an investor, let's say, so you will pay, the face value is $10,000 in this illustration, and it's a 5%, I don't know if you can see it here, it's a 5% fixed rate bond. So you invest £10,000, it's an outflow for you, then every year, every 6 months you'll get a coupon of $250, right? So every year you get two coupons, which is $500, which is the 5%. This is your inflow. Until maturity, you'll get your final coupon and you'll get redemption of $10,000, which is the face value. So these are the simple cash flows of a bond that a Sukuk must replicate. Okay, so this is the basic Sukuk structure. We'll start at the bottom. These are the investors, the investors who have the money, right? They want to buy the Sukuk, invest into the Sukuk. So we have an issuer, which is an SPV, a special purpose vehicle. It acts on behalf of the investors. So the investors give the money to the issuer, and now the issuer does three things. First of all, it does some kind of transaction with the seller, and often it's a purchase of assets. Not always, but often it's a purchase of assets using the money from the investors, right? So the Sukuk proceeds are invested or used to enter into transactions with the seller. The seller is the issuer, the entity, the government, or the corporate that wants to raise money. Then throughout the life of the Sukuk, periodical payments, these are effectively the coupons that are being paid by the issuer. In this case, the role it plays is the servicer, right? So the seller, servicer, and purchaser are often the same party, which is the issuer, which is the obligor. Okay, I should use correct terminology now, because the issuer in the Sukuk is this SPV here. It's not the party that's raising money. The issuer is the SPV acting on behalf of investors. And the party that's raising the money is called an obligor. There's a couple of other words for it, but obligor is the most common one. So you have the servicer, which is also the obligor. So throughout servicing the assets, the obligor will deliver regular payments, periodical profit payments, as a result of owning the assets, right? The issuer owning the assets, they get regular payments, and from this they will make the coupon distributions or the profit payments. So in bond terms, it's coupon because it's interest. In Sukuk language, they don't like to use coupon because it implies interest. So they use profit payments, periodical profit payments, or periodical distributions. So these will go out throughout the life of the Sukuk, paid, quarterly, monthly, annually, whatever the Sukuk is. And at maturity, the obligor will act as purchaser. It'll buy back the assets and it will repay money to the issuer. The issuer will then repay money to the Sukuk investors. This is a basic Sukuk structure. I mean, Sukuk structures are some of them are quite complicated, but this is a basic one. Okay. So let's compare the cash flows now. The initial loaning of the money. In a bond, it's simply a loan, right? You buy the bonds and you just give the money to the issuer. In a Sukuk, the money is used to purchase assets. So there is a slight difference. If you look at the annual repayments or the regular repayments in bonds, it's just purely interest and coupons. In a Sukuk, these are returns from the assets owned by the investors. And at maturity in a bond, the loan is just repaid, the face value. In a Sukuk, the assets which are owned by the investors, they're sold at maturity, and the proceeds go to the investors. So these are some key comparisons, I would say. Okay. So now here I just Googled some the difference between Sukuk and bonds. And you'll see standard of the next couple of slides. I've got a couple of standard lists. So this outlines, typically if you learn about Sukuk, this is what you'll be told. So that there's a key difference between Sukuk and bonds. And so we can see, I'll just read them quickly. One, Sukuk is ownership in assets. Bonds have no ownership. Sukuk, the pricing is by profit sharing. Bond is interest rate. In Sukuk, the profit is after risk sharing. And in bonds, it's just interest, fixed or floating. In the Sukuk, the payoff is after income earned. And in bonds, there's no risk sharing, right? The issuer has to pay the interest or its default. And Sukuk talks about asset backed. So you need assets here. In the bond, you don't need assets. You just pay interest. And this is another table that shows the difference. So in a conventional bond, it's a debt obligation. Sukuk is a shared ownership of assets. And a conventional bond, the funds can be used to finance any business as long as it's legal. In an Islamic Sukuk, the asset of the project has to be Shariah compliant. The issue price in a bond is based on the rating of the issuer. In a Sukuk, it's based on the market value of the assets. The return on the investment on a bond is just interest. On a Sukuk, it's shares of profits from the assets. And the risk in a bond, interest rate fluctuations, default risk, which is credit risk. In a Sukuk, apparently we don't have any of these. We have a risk of sharing a loss, which is the performance of the asset, and default risk. So, this is a standard presentation of the differences between Sukuk and bonds, and virtually all of these are wrong. Right? They're just plain wrong, and they're often, I don't know. I don't know what else to say. So now let's carry on with showing why they're wrong and analyzing the difference. Okay, so Sukuk versus bonds. So Sukuks are actually very different to bonds. That's the claim. My view is that they're not different at all. And I will show why. So my view is Sukuks are built on interest in every meaningful way. They operate precisely the same as a bond. The injection of any assets is window dressing. The investors never take a risk on the assets, never have any risk on the assets to generate profits. All risk is credit risk on the issuer, which is the obligor. And payments are based on this credit risk, which is just like interest. Actually, this is precisely what interest is and what riba is. Okay. Okay. Right. Okay. So I think now we can look at the Sukuk transaction. So what I did, I just picked the latest one I could find on the database. So Sukuk.com is a pretty good database. It's one of two that I use. So if we just look at, so hopefully you can see the webpage. This is the Sukuk.com. It's the website now. So all I did was, if you go into the issued Sukuk profiles, you can see the list of Sukuk here. I just picked the last one. This is the most recently issued one. ICD, Islamic Corporation for Development of the Private Sector. So this is an arm of the Islamic Development Bank in Jeddah, and they do a lot of good work. They're helping Muslim countries in general. And so this is a Sukuk issued by them. 2025 is the maturity. So it was issued in October. I think if I click it, we can have some high-level information. So, I don't expect you to read this, but it's there. If you want to go to Sukuk.com, you'll find this there. So the issue size is $600 million. It was issued on 15th October 2020. So this is the latest global Sukuk that's issued. It's the most recent one, so that's why I chose it. Tenor is 5 years. And the profit rate, if you can see here, is 1.81%, which of course is claimed that this is profit on risk and assets. It's not an interest rate. So if you look here, you have links to various documents, and from here I just downloaded the prospectus, and I'm going to open it in a PDF reader. But it's a public document. That's why I like Sukuk. So this is the transaction that I've chosen. No, where do I want to go? Okay, so this is just a screenshot of the Sukuk details. So now let's go into the document. So if you, I have the document open, so let me. So this is the document itself. It's 164 pages, right? And it's a complex document, but I'm just going to focus on the aspect about the structure and how it works. So this is the diagram of the structure, and let me see. I have it in the presentation. So this is the diagram in presentation. I don't know if you can read it all, but I just want to go through what the structure is, and this is a typical Sukuk structure. So I think I have it here. Yeah, so okay, so hopefully you can see this. So the only thing about Sukuk structure is that they don't, and I don't know why, they don't label the ordering of how these things occur, right? So we'll go through this quickly. So we generally start at the bottom with investors because they have the money, right? We generally start with investors. So what they do is, first of all, they invest the money here. So we can, I'll try to number these. So this is one. They invest the money and they get Sukuk certificates, which is two. And then what happens is, this is the trustee now, or the SPV, and this will use the money to invest in some kind of assets. So this is step three. It's going to use the proceeds and it buys assets. Okay, and we'll discuss what these assets are. And this is the master purchase agreement. This is a documentation that allows step three to occur. So now the SPV, in theory, owns the assets, and now it's going to get regular income. So it's going to get this step four, portfolio income, and from this is income from the assets, right? So from this, they're going to pay periodic distribution amounts, right? So this is number five. So this is effectively the coupon, which is fixed or floating. It doesn't matter. And if it's semi-annual or annual, that's what they're going to pay. Okay. I mean, if you can't see this wording, don't worry. It's not crucial. I'm going to explain everything anyway. But hopefully you can get some sense of it. So after the periodic distribution, what happened? All that's left is at maturity. You're going to get the dissolution, it's called, or the redemption. And this is all step six here, all of these things. And then once the Sukuk certificates, well, the assets are sold, ICD as the obligor will repurchase the assets. It will deliver the money to the SPV, and the SPV will deliver the money to the investors. It's called the dissolution amount. This is seven. So this is roughly the steps that are taken. And this achieves the things we talked about, that the cash is being delivered to the trustee and to the obligor through the purchase of assets. The regular profit payments are paid by the utilization of assets, and at maturity, the obligor purchases the assets and gives the money back to the investors. Okay, let's go back to PowerPoint. Okay, so now these are the key questions we're going to look, and we're going to answer. We're going to look in the prospectus and find answers for them. So the key questions are: how are the proceeds used? Let's try to understand exactly what assets are purchased. How were the returns generated? What is the stated return? I mean, we know that already, it's 1.81%. And now, what if the assets earned less than expected profit? Because assets are real things that you can't predict what they're going to earn, right? They could earn more or less. What happens if they earn more than the expected profit rate? Now, because they're real assets, the price is going to rise and fall. So what happens if the asset value rises and falls? How does this impact the investors and the Sukuk price? And then the repayment at maturity, is it based on asset price and value? So these are all linked to the claims made, that how Sukuks operate and how they're different to bonds. So these are the same questions now, but with the theoretical answers. How the proceeds used, they're used to buy assets, which is true. How the returns generated, they're generated from the assets. This is not true, but I'm stating the theoretical answers you'll get. What's the stated return? This is in the documentation, it's 1.81%. What if the assets earn less than expected profits? Now, in theory, the investors should get less return because they're taking risk on the assets. This is, what the tables we looked at, they all talked about profit sharing and risk on the assets. So if the assets earn less, the investors should get less. And if the investors earn more than the expected rate, the investors should get more, right? That's the whole point of taking risk on assets. If the asset value rises or falls, then the Sukuk price should rise or fall in line with the assets, because this is what the investors own. Is a repayment to maturity based on the asset price? The answer should be yes. This is all theory, right? This is how it should work. Conversely, all of these are wrong. So let's look at the documentation and go through these. So the use of proceeds. So this is, I've just copied this from the prospectus. This is on page 1. Okay, so the trustee, this talks about the use of proceeds. So this says the net proceeds on the date of the agreements to purchase from the ICD. This is the obligor, a portfolio of assets created by the ICD, which shall be separate and independent from all other assets of ICD. It just says assets, portfolio of assets owned by ICD. And let's try to find some more details. So this carries on to describe this. Now this is a reasonably complicated paragraph, right? So I'm going to try to explain what this means. Shall not exceed 33%. Okay. So this is saying this is a mixture of assets. Some are leased assets, which is normally ijara agreements, and some are istisna. Istisna is project finance. So these are the kinds of financing that ICD has already undertaken. So they've undertaken transactions, and these are assets on their books. So these are the assets that will be injected into the SPV. And they talk about a certain percentage. And they talk about 33% of shares being tangible. And if any of them are contrary to principles of Sharia, it should not exceed 33%. Okay, so let me explain why they mentioned this. And this is an interesting point about Sukuk. So let me go to we're here. So let's go to some writing. Okay. So this talks about 33% and 67%. And why do they talk about this? So when you have a Sukuk, you have a pool of assets, right? And these are often, it's not one asset often because the issue size is quite large. So you have pools of assets, groups of assets. So you might have 10 different types of assets, or you might have 50 different types of assets that make up the asset pool, right? So it's a mixture of assets. So based on the ownership of assets, there's a Sukuk certificates are drawn, and this is what the investors own. They own Sukuk certificates, and Sukuk certificates are quoted in the market often, right? They're listed and they're quoted for the major Sukuk, so you can buy and sell them on stock exchanges, for example. Now, in order for it, so what it means is when they're quoted that they can be traded, right? So in order for an asset to be traded, there are certain rules in Islamic finance that must be met for it to be traded. And these rules relate to debt, right? So you can get Islamic debt, right? You can give an Islamic loan, and this is an asset on the lender, right? But the problem is you can't trade it. You can't trade pure debt. So there is a slight difference of opinion in regions. So for example, in Malaysia, which follow, how can I say this? Slightly different set of rules according to, it's often linked to the madhab. So in Malaysia, some of the rulings are according to the Shafi'i madhab. And in there, the scholars rule that the trading of debt is permissible in general. But in the rest of the world, which follow different madhabs, you often cannot trade debt. So what this means is, can I scroll down? No. Oh, I can scroll. Okay. So what do you mean by trading debt? So let's say you give a loan to somebody of 100. And okay, let's just say they're going to repay you 100, right? This is an asset. This is the debt repayment. It's an asset to you as a lender. Now you can sell this asset. I don't know of any madhab that prevents you from selling this asset. But the majority of madhabs will say that you must sell it at £100. You've got to sell it at face value because you cannot trade debt. You cannot assign a different value other than what's being repaid. But in Malaysia, which follow the Shafi madhab, you can trade debt, means you can sell it at something other than 100. So you can sell it for 90 or 110 according to the market value, right? So in Malaysia, you can do this, but outside of Malaysia, generally, you cannot. So when Sukuks are offered, especially international Sukuk, everybody wants to follow globally accepted rules. So they tend to follow this rule, that you must sell it at 100. So if a Sukuk is just being sold in Malaysia, then it's no problem. They can follow this rule. But investors from the rest of the world will not enter this Sukuk. So for domestic Sukuk, it's fine. You can do this. But even with Malaysia, the Malaysian government or Malaysian corporate or a Malaysian bank issues international Sukuk, they will follow these rules because investors will follow these rules in general. So what this means, this has an implication on what we're looking at. So when you have the pool of assets, okay, let's say the value is 100%. So you can have some debt in them, like we talked about, and the rest can be, I would say, asset based. That's not debt. Equity, like we call it equity, but it's not really equity, right? So it'll be a mixture of these, right? So you'll have X% of debt and Y% of equity. So the 33% and 67% puts limits on this, right? Meaning that they will allow, and they often it's in thirds, right? So it's 1/3 or 2/3. So it's often, and this is where we get 33% from, 67%. So they'll allow debt of the whole asset pool to be a certain portion of the whole asset pool, right? And then, so if debt is, for example, 33%, then the whole pool will generally be seen to have the characteristics of equity. So you can trade the pool, even though it has debt, because it's below a threshold. So this is the purpose, this is the reason why they put 33% minimum tangible assets, so that debt remains below a certain threshold, so the whole asset pool is tradable, meaning the Sukuk certificates are tradable. Okay. Let's go back. So this helps to understand the nature of the assets. Okay. Do investors actually own the assets? So this is from the, again, this is from the prospectus. I've just copied and pasted here. So it says the portfolio includes, without limitation, the right to receive payments in connection with the assets, the right to demand, sue for or recover amounts payable, right, under the assets, and the right to sue on all covenants if ever ICD. So effectively what they're saying is the portfolio is the right to receive payments. It's not the actual assets themselves. So let me explain what the difference between this is. So if, let's say you have a real asset, right, and the asset generates a return. Okay. Now, if X is the owner and he sells the assets to Y, now Y is the owner, so clearly he's going to get a return, right? But this is not what a Sukuk does. What a Sukuk does, it just takes the return and it sells the right of the return to the investors. And the language used in Sukuk, often it's like, sometimes they call it beneficial interest. How do I spell it? Is that right? I don't know. Beneficial interest in the ownership or beneficial ownership. These are the languages they use, meaning that they don't actually sell the asset. They just sell the benefits of ownership, which is the right to receive returns. Now, this is a very important distinction, right? This is exactly what this paragraph says. The portfolio includes the right to receive payments in connection with such assets. So they don't actually buy the assets. And this is pretty much true for every Sukuk I've seen. And there's a reason for this. The reason is that ICD in this case, right, they have very significant assets on their balance sheet, which are financings, project finance, Ijara finance, and other kinds of shares, for example. And if they sell, let's go back to the writing. So if there's an actual sale, right, so this is referred to as a true sale. If there's an actual sale, then if you're the owner of the asset, right, and you sell something, one of the things you must do if you sell it, you must take it off your balance sheet, right, because you no longer own it. You must take it off balance sheet. And Y, who's a new owner, it goes on to his balance sheet, right? I just put BS. This must happen if you sell something, right? So in Sukuk, the owner is the obligor. It owns the assets and it's selling it to the trustee. Now the obligors don't want to take it off their balance sheet because it's their asset, and then they don't want to sell the asset, so they just sell the rights to it. So there is no such thing as a true sale, and this has significant implications. I mean, this is something that should occur, even according, we will talk a bit about AAOIFI Shariah standards. There should be a true sale, but there isn't. So it's just a sale of beneficial interest, right? Whatever language. I mean, I've been doing these for years with lawyers, drafting these agreements, and I've still never really understood what beneficial interest is. But this is what you buy. This is what the investors are buying. They're buying the right to receive the income and the cash flows from these assets. They're not buying the assets themselves. Right. Okay. So first of all, I mean, this puts a lie to the claim that investors buy assets, because they don't. They buy rights to receive income from assets. Right, so let's look at the situation where assets generate less than 1.81%. Right, so this is very important to understand this. Why should we answer this? So once you own assets, right, you should get a return according to your assets. If your assets perform well, you get a higher return. If they don't perform well, you get a lower return. This is, if some of you trade, I mean, I do some trading courses and I run some um, groups for trading. Now, whatever you trade, if it's stocks or crypto, once you buy it, it's yours. All the risk is yours. If the price goes down, no, if the earnings go down, it's what you get less earning. If the earnings go up, you get higher earnings. That's what owning something means. So if you're the owners of the assets in the Sukuk and the assets generate less than the expected profit, then you should get a lower return. This is common sense. Now, if this was a bond, you would get the return regardless, because this is what interest is. Regardless of any profits made by the borrower, you get 1.81%. This is what interest is by definition. But this is one of the major differences between a Sukuk and a bond. Your return is based on your asset, right? So if the assets generate less than 1.81%, the investors, according to common sense and according to the theory of Sukuk, should earn less than 1.81%. Okay, let me just admit some more people. Okay. So let's read what happens. So this is again from the prospectus. So it says there's a guarantee. The ICD issues a guarantee. The ICD is the obligor. It is guarantee the punctual performance of any payment obligations arising from the portfolio. So this payment of expected profit is an obligation. So so they agree to pay all the obligations. Okay, in order to enable the timely payment of profit amounts. And the profit amounts are 1.81% per annum. So let's look at some further explanation of this guarantee. So this is on page 45. So there's a lot here, but I just want to highlight a bit of it. So this talks about shortfall. So let me explain what this shortfall is. So we have on the Sukuk, one second. Let me mute everybody, I think. Not everybody's muted. Okay. So we have 1.81%, and this is just the expected profit rate. You can't guarantee profit in a Sukuk. You can't guarantee returns. So this is expected. Okay. 1.81%. So if the assets earn less, let's say the assets earn 1.5% in a particular year. This is less than the expected rate. So here we have a shortfall, right? This shortfall has 0.310%, right? It's a shortfall. So in theory, the investors should get the return of the assets. They should get this, right? This is what they should get. But what this documentation says, and also Sukuk do this, it says if there's a shortfall, right? This is the shortfall now, 0.3%. This clause says, in respect of, right, if there is a shortfall between the periodic distribution amounts due, this is 1.8%, right, and the profit collections received, so this is in our example 1.5%, there's a difference, there's a shortfall, okay, such that the trustee would be unable to pay the periodic distribution amount. So that's true. So if the trustee is receiving this, from the assets, it is unable to pay this, right? I hope you see that. It can't pay more than it's received in profits. So this is a shortfall, right? Now we go here. Oh gosh, don't want to do that. Here, I don't know if you can see where my cursor is here. The ICD shall immediately pay to the trustee the amount of such shortfall, right? So what it's saying is the ICD now will step in as the obligor. This is the issue of the bond, right? The ICD will step in and it will pay this shortfall. It will just give it to the trustee. So this 1.5% and the 0.3% will just be given to the trustee. They're just going to pay it, right? And once the trustee has 1.81%, it's going to pay this to the investors. So you can see if the assets earn less than they're expected, the obligor will just step in and give the money, right? So the investors do not face risk on the asset performance. This is a lie. Right, let's look at the next scenario. Okay, so the assets, I'm just confirming it. So the investors will always receive 1.81%, even if the assets do not generate this amount. The ICD just guarantee this amount and they pay it. This is in the prospectus, what we've just seen. Now this begins to sound a bit like a bond, where the issuer of a bond must pay the coupon, otherwise it's a default. Right, so it's beginning to look a bit like a bond. So let's look at the case now where the assets outperform the expected return. So let's say the expected return, okay, which we know, 1.810% annually. So it's per annum. Let's say the assets do well and they earn 2.51%, okay, which they can, right? So this is an excess of 0.7%. Is that right? Yeah. 0.70% excess, right? The assets are earning greater than the target profit rate. Now, in a bond, the investors will always get this because it's interest. Now, in a Sukuk, when the assets outperform the expected rate, the investors should get this because they own the assets in quotation marks. But we've seen that they don't own the assets; they own beneficial rights. So they should get this in theory, right? They should. So let's see what happens. Because Sukuk is not a bond, right? The interest is interest. It doesn't change. But profits from the assets should go up or down according to the performance of the assets. So let's look at this. Now, on page 46, the reason I'm giving the page is if you want to download the prospectus from that website, you can, and you can find everything I've copied from the prospectus. I've not made anything up. It's a public document. So first of all, the trust assets. This is a defined term. So these are the assets owned by the trust. So the trust assets means the assets, rights, cash or investments described in condition 5.1. So this is condition 5.1. Of course, you can't read this, okay? And you don't need to read it. But there's only one point here, which I've circled here. So part of the trust assets are monies standing to the credit of the transaction account. This is what we're interested in. So let's see what actually goes into the transaction account. So here, transaction account means the account in London, into which ICD will deposit all amounts due to the trustee. Okay, so the profits generated by the assets are paid by ICD into the transaction account. Right, so the certificates will still pay 1.81%. This is what will happen. So this is what they're saying. So the assets earn 2.51%. This amount is paid into the transaction account. Okay. 2.51%. Now let's say the time comes to pay the next payment of the Sukuk certificate holders, which is this. So they're going to pay 1.81%. That's what the Sukuk certificate says. So there's going to be an excess of 0.7% in this transaction account. Right, and this is for 1 year. So let's say all the other years, let's say the actual profit earned is 1.81%, right? All the other years. So there's no further excess. So after the 5 years of the Sukuk, there's an excess of this percentage. Now we can work it out because we know the face value is $600 million, right? So you can multiply that by this and get a number. Actually, let's do that. We should do that, but gosh, how much will this be? 600 times 0.7%, $600 million. That's the size of Sukuk. So 1% is, yeah, this is how I do my math. So 1% is $6 million, right? So 0.7% is what is it, $4.2 million? It looks right to me. I mean, I hope I'm not making a silly mistake. If some of you are better than me at maths, you can just confirm that what I've said is okay. $4.2 million. Okay, thank you, M. Kabir. I'm presuming you're more intelligent than me, so it's correct. Okay, so $4.2 million. Oh gosh. Okay. So this is going to be, so in all the future years, let's say the actual amount is earned. So there's no future excess from, no further excess. So the amount of excess at maturity is $4.2 million. This is a credit balance in the transaction account. Yeah, this is exactly what it will be. Right, so during the life of Sukuk, the investors will get 1.81%. So what happens to this excess $4 million? The investors should get it, right? Because it's their asset. So let's see what the document says. So what happens to the excess credit amounts? So the document says quite clearly, the application, this is section 5.2, whatever page it is, application of proceeds from trust assets. So what it says, when you have trust assets, it gives a whole list. It's called a waterfall, right? So it's the order of which it uses this money. So it says, first of all, this is paying it's administrative costs. It's got to pay its administrative costs. So, and it goes first, secondly, so it's got to pay the amounts that the trustee has to pay, including rating fees, listing fees. So these are costs related to issuance. So these are other kind of administrative and issuing costs. Thirdly, on any periodic distribution date, so this is when the effective profit's being paid, they've got to pay the profits to the investors. That's what they have to do. Fourthly, on the dissolution date, which is the maturity date, they've got to pay all amounts required to redeem trust certificates. So that this is at maturity, right? So they've got to pay the redemption amount. We'll look at that next. Then what happens after that? We have this excess balance of $4.2 million. Fifthly, subject to everything else being paid, this amount is paid to the ICD, which is the obligor, as an incentive fee, right? In its capacity as servicing agent. Now, servicing agent was something we saw in the diagram. It's the role it plays in managing the assets for the 5 years. If you remember, the ICD plays 3 roles. It's the purchaser, it's the seller of the assets. It manages the assets as a servicing agent for 5 years, and then it purchases the assets. So in its role as servicing agent, it's going to get this excess of $4.2 million as an incentive fee, right? So this excess goes back to the obligor. So the investors never receive excess profits, right? So this is an important point, right? So what we've seen is the expected rate is 1.81%. This has to be expected. You cannot guarantee a return from a dynamic pool of assets. It's not in accordance with Sharia. You're breaking Sharia rules if you give a guaranteed return on a dynamic pool of assets, right? So this is expected. But we've seen that if the profit is less, let's say it's 1.5%, right? If there's a shortfall, right, this shortfall is 0.31%. We've seen already that ICD will just, ICD will just pay it. And if there's an excess, so if there's an excess, we've looked at $4.2 million, we see that this goes back to ICD as an incentive fee for servicing agent. So in any case, if there's a shortfall or an excess, what do the investors get? The investors get 1.81%, regardless of what the assets have done. If they underperform or overperform, the investors get 1.81%. Now, this is beginning to look very much like interest, because it's clear that the investors have zero exposure to the assets in performance, right? They have no exposure to the assets. So all the risk that they have is the ability of the ICD to meet the shortfall, because that's the only risk that they have. Because if there's an excess, then the excess goes back to ICD. If there's a shortfall, ICD has to step in to make the shortfall. Now, the only risk they face if the ICD, if it's unable to meet the shortfall, it says we can't do it. Now, this is no different in a bond to the issuer saying, I cannot pay the coupon. This is no different. This is a default. And if the ICD is unable to do it, this is a default because they've given a guarantee. So I hope you can see that this works out exactly like a bond, right? There's nothing to do with the assets. Right, let's keep on going. Now look at the repayment value on maturity. Now in a bond, the face value is repaid. So if this was a $600 million bond, it would be $600 million repayment. But this is not a bond. This is a Sukuk. Hold on, I'm just letting people in. Mute everybody. Yeah, okay, so this is not a bond, this is a Sukuk. So the asset, the repayment should not just be face value because it's not repaying a debt. It should be something to do with the assets because investors own assets in some kind of way. So if the assets have gone up in price, remember 5 years have passed, right? So assets can go up in price, they can go down in price. If the assets go up in price, then when the investors sell the assets at maturity, let's go back to this diagram. So I know you can't see it all. Actually, no, let's do a better diagram. Let's go back to this diagram. So here we're talking about part 6, which is a repayment at maturity. So if the assets have increased in value, this exercise price, this is what's paid. Exercise price. This should be the value of the assets. It should be more than $600 million. And if the assets go down in price, the exercise price should be less than $600 million. Investors should face the risk of the assets at maturity. This is one of the key things that we saw in those tables that differentiates it from a bond. A bond will repay face value because it's a loan with riba. Sukuks, investors own assets. When the Sukuk is redeemed, they are selling the assets. So they should receive a value equal to the value of the assets. This is a theory. Now let's look at what actually happens. Right, Sukuk are all about risk sharing, profit sharing, asset. Sukuk price is based on the asset. This is all the theory we've heard, right? Which I've told you is a lie. So let's look at how investors repaid at maturity. So in a bond, you just pay face value. In a Sukuk, investors sell the assets. Let's see how the sale process works. So this is this part of the structure diagram, which I've just talked about. Okay, and he talks about purchase undertaking and sale undertaking. So we will look at those. Gosh. Sorry, 1 second. Okay, I think we're okay. So now we'll look at purchase undertaking and sale undertaking. Let's explain what they mean. So we have a purchase undertaking. So what this means is, let me try and draw something for you because it's not always clear from the diagrams, right? I understand that it's quite small. So let's start a new thing. So we have, okay, let's understand where we are. So we're now coming up to maturity, right? And the Sukuk holders, they own certificates, but they want to be repaid. So the trustee is a SPV acting on their behalf. This owns the assets. In theory, it owns the assets. So at maturity, it's going to sell the assets. Sell them to who? It's going to sell them back to ICD as the obligor. In this role, acting as purchaser now. It's a purchaser of assets at maturity. So at what price is it going to sell them? Now, this is $1 million question, right? Remember, the face value of this Sukuk is $600 million. But these assets could have a value. They can go up or down, right? It could be 500 or 700, right? Okay. So the transaction we want to take place is a trustee who's acting on behalf of the investors. Trustee needs to sell the assets, whatever the assets are, right? Doesn't matter what they are. They want to sell assets to the ICD as purchaser, and it's going to get a certain amount of money, but we don't know what. Right, so these are the assets that must take, these are the transactions that must take place. So in a bond, at redemption, this is at face value. So if this was a bond, this would just be at 600. But they cannot say this. So you cannot have in the documentation. So remember, the documentation is executed at the start, October 2020. The maturity is October 25. So this maturity, of course, it's 5 years later. So you cannot sign a document in 2020 at the time of launch to say that in 5 years' time, the trustee will sell these assets to ICD for $600 million. You cannot say this. In Sharia, you cannot say this because this is a forward transaction, right? You're agreeing to sell an asset in 5 years' time, and you're agreeing to deliver the asset in 5 years' time and pay for it in 5 years' time. This is a forward transaction. This is not permissible. You cannot agree this. So this is why every single sukuk I've ever seen, they use undertakings. Now, an undertaking, the Arabic word in Sharia for this is a wa'ath, right? And this is something like a promise. It's a bit different to a contractual agreement. It's slightly different because it's binding only on one party by the maker of the. If you make a wa'ad, it's binding on you. So it's binding on one party. If you have a contract, like a forward transaction, right? This is binding on two parties. Both parties are obliged to fulfill their obligations and duties. In a wa'ad, in an undertaking, only the party the maker of the wa'ad, only the party that makes this undertaking is binding on that party. So it's different to a contractual obligation. And sometimes this difference is just, I don't know. It's just, well, I don't know what to say. But there is a difference. I mean, there's been many white papers written on this as a difference. It's just a construct, in my view, to achieve a certain thing. It's not really building on the natural and inherent differences on these instruments. Okay, so what they do, instead of doing a forward transaction, they do undertaking. So you have two undertakings. So you have which one are we looking at first? We're looking at the purchase undertaking first. So you have the ICD who's going to buy the assets, remember? So their ICD will make a purchase undertaking. So they make this undertaking in 2020 at the start of the Sukuk, and they say in 5 years' time, so 2025 at maturity, we will purchase the assets from the trustee. And this is the Sukuk assets, right? For what price? We don't know yet. For a certain price. This is a unilateral undertaking. It's not a contract, so it's not a forward agreement, right? It's a undertaking. It's not a forward agreement, so if it's forward agreement, it's impermissible in Sharia. So they're avoiding this by doing, I'll spell this wrong. You'll notice my writing is not fantastic, but that's the way it is. So I won't apologize for it. I just know it's not very good. So it's impermissible. So that's why they do undertakings. So there's a purchase undertaking issued by ICD. It's binding on ICD. It's not binding on the seller, which is the trustee. So now on page 130 of the prospectus, it talks about the purchase undertaking made by the ICD to the trustee. The purchase undertaking deed will be executed by the ICD in favor of the trustee. It be governed by English law. So the ICD will irrevocably undertake to purchase all of the trustee's rights, benefits. So first of all, notice how they talk about the trustee's rights and benefits. They don't talk about the trustee's assets because the trust never bought the real assets. It just bought rights and benefits. Okay, so it's going to buy all of the trust assets, which are rights and benefits and entitlement. It's going to buy them. It makes an undertaking. Now, okay, I'll make this point about assets, because the assets were never sold. It's just the rights of the assets were sold. So now, at what price will this undertaking state that ICD will purchase the assets? Now, it should be at market price, because there's only one price of assets. It's the market price. If this was a bond, right? If this was a bond, you would ignore market price completely of the assets, right? Because you have no assets in the bond. It's just an IOU. So you ignore market price and they would just deliver the face value of the bond. Right? This is what you do in a loan, in a bond. You deliver face value because it's a loan. When you repay a loan, you repay face value. That's what you do. And in terms of the profit, that's because the profit is interest along the life of the bond. It's interest, and so at maturity, you repay the face value. So what we're looking for is market value. This is what should happen in a Sukuk. Now let's see what the prospectus says. Now, the purchase price payable should be equal to the aggregate nominal value of the relevant series. Right? So the aggregate nominal value is the face value. Right? That's exactly what they're saying. So the ICD, when it purchases, so let's go up a bit. This is the purchase undertaking. So ICD issues a purchase undertaking to purchase the assets from the trustee, and the price is the face value, which is $600 million. So that's what they're saying. We'll buy the assets for $600 million. But it's unilateral, right? This is an undertaking. So the seller, which is a trustee, is not obliged to accept it. It can say no. Right? So if it says no, so let's say, for example, the assets, the face value $600 million. ICD say, I will pay you $600 million because I've made this undertaking. Let's say that the actual assets valued now by the trustee, they're worth $700 million. The trustee in theory would say, why would I sell it to you for 600 when it's worth 700? Trustee can say, no, thank you for your undertaking, but no, I'm going to sell them in the open market for 700. This is a logical thing to say. Yeah, it's a logical thing to say. So this is a risk for the obligor, because the obligor wants their assets back. It's always their assets and they don't want to sell them. You know, in fact, they have never sold them. I've told you they never sold them, but they want the rights that they've sold. They want them back. So they don't want the ICD to be, they don't want the trustee to be able to say no. So this is why the trustee now issues a sale undertaking. It commits unilaterally to selling the assets at maturity. So what they say now is, at maturity, we will sell the assets to you, to the ICD, for a price. Now, again, if they own assets, the price, it should be market price. Right? And I've said in our, let's assume the market price is 700, not 600. So let's examine this sale undertaking now. Let's look at the sale undertaking, page 130. So it will be made by the trustee agreeing to sell the assets at maturity to ICD. Surely it must be at market price. It cannot be at the face value, which is the nominal aggregate value of the Sukuk. So let's see, the purchase, this is now related to the sale undertaking. The purchase price payable by the ICD will be amount equal to the aggregate nominal value. Right, so this is saying in the sale undertaking, it's also going to be $600 million. Right, so this is saying, it doesn't matter what the value is. In fact, if the value can go down to $500 million, it doesn't matter. It's totally irrelevant, because both the purchase undertaking and the sale undertaking, right, both of them specify a price which is $600 million. So this means whatever happens, this transaction will take place at $600 million. It cannot, first of all, by having a purchase and sale undertaking at the same time, it means you're 100% sure the transaction will occur, because one of these will always be valid. You can never avoid this transaction. So 100% is going to occur. So this is how you effectively create the forward agreement. They're creating all the obligations by using two undertakings, but you cannot execute an outright forward contract. So they're replicating it by two undertakings. Also, Sukuk do this. This is a derivative, but they do it by combining building blocks, not by outright, because if you do it outright, it's not Shariah compliant. No scholars will allow it. And the second thing that this achieves is the price. The price is fixed. It's fixed at face value, $600 million. So this doesn't matter if the assets are worth 700 or 500. Right? So the investors get no benefit if the assets go up in price to 700. And the investors face no risk if the assets fall in price to 600. Right. So I hope you understand the implications of this. So how can this be? So what does this mean? So just as I've explained, if the final asset value is anything over $600 million, the investors never get that benefit. And if the final asset value is less than $600 million, the investors never face that risk. Right? So if you go back to, so the redemption is always face value. And now if we had a bond that was issued at $600 million and it paid 1.81% interest, right? This is riba. And then at redemption, what price is that redemption of the bond? It's $600 million, right? Face value. And have you seen that everything we've looked at ensures the Sukuk does exactly the same thing? It pays the guaranteed amount of 1.81% and it delivers at redemption the guaranteed amount of face value, $600 million. Right. So that's the technical analysis of the live transaction. We've gone on for over an hour, so I do apologize, but I do want to finish what I'm going through and I want to explain it reasonably well. So what I would say is that this is actually a very simple Sukuk transaction, right? I've looked at transactions that are much more complicated than this. This is actually very simple, but every Sukuk transaction I've seen does exactly the same thing. Okay, I'll just see if there's any questions. Okay, nothing. So, okay. So what have we discovered? So the investors buy assets through the trustee, but remember the trustee doesn't buy any real assets. It just buys beneficial interest to the benefits of owning the asset, which is the cash flows. It never buys the actual assets. There is no true sale. So Cook's certificates agree to pay 1.81%. This is estimated. The estimated profit as a result of owning the beneficial interest in the assets. Now, if the assets generate more than this, the investors still get 1.81%. If the assets generate less than this, the investors still get 1.81%, right? So every aspect of owning the asset is removed. It's like you don't own the asset. It's like you're getting interest. At maturity, now the final aspect of owning the assets is that you sell them at market value if you own them. Now at maturity, if the assets are worth more than $600 million, the investors will still get $600 million. If the assets are worth less than $600 million, the investors will still get $600 million. Right? So you can see every single aspect of this whole transaction related to the assets is stripped out. Right? Investors get no benefit and they face no risk of owning the assets. Right? Compare this to a bond. If you invest in a bond, let's say the same terms, you're going to get 1.81% regardless of the performance of the obligor. They are guaranteed coupons, which must be paid or there's a default. Now at maturity, for a size of $600 million, you will be repaid $600 million or it's a default. So can you see that these are the defining aspects of a bond, and they work out exactly the same as the financial characteristics of a Sukuk. There is no single difference in any aspect, right? But one is a Riba-based instrument and one is Shariah compliant, in theory. So if you look at the assets, so one final test you can do about if you actually own assets, right? If you buy something, like if I order something from Amazon, right? Let's say I order a new sofa from Amazon or anywhere. I take it home and I can do what I like with it. You know, I can put it in whichever room I like. If I don't like the color, I can change the color. You know, if I want to put it in my garden in the UK, it's not a good idea because it rains every day. But if I want to do it, I can. If I want to damage it, I can. If I want to throw it out, I can. If I want to jump on it and take a knife and cut it open, I can, because it's my asset, right? If you can't do these things, then you have to question whether it's yours. Like if I'm leasing something, if I'm renting a house and I have furniture in there, then I can't do these things. I can't damage them because they're the landlord's assets. And if I damage them, I have to repay the damage because they're not my assets. So I hope you can see there's natural tests to be satisfied if you own something. So let's look at these assets that this beneficial interest and all this nonsense that the investors buy. So let's see if once the trustee has purchased these assets on behalf of the investors, what can the trustee do with these assets? All right, this is a test of ownership. So in the document, okay, you can't see this, of course, trustees' covenants, but I do have it on the next page. Okay, so I've taken the key paragraph, paragraph C. It says the trustee shall not sell, transfer, convey, or otherwise dispose of its legal title. Apparent ownership. Have you seen, look, even in here, even in the document, they talk about apparent ownership because it's not real ownership. So to the portfolio of the relevant series. So it says the trustee cannot do a single thing with these assets. Nothing. Except pursuant to the purchase undertaking and sale undertaking. So except to sell the assets at maturity for a price that's already agreed of $600 million. So the trustee cannot sell the assets in the open market. It cannot change the assets. It cannot do anything with the assets. Now, this is no different to not owning the assets. So once you buy the assets, so first of all, this is the whole nonsense about assets in Sukuk, right? Even in the document, I just showed you, it says apparent ownership in brackets. So first of all, if you're an SPV, if you're the trustee, you only own rights in the assets. You don't own the assets themselves. And you have no ability, you can do nothing with the assets. You can do nothing that an owner would do with the assets, right? And if they underperform or if they overperform, it has no impact on you because you're going to get 1.81%, right? And if the value falls down, if it falls to $500 million or it rises to $700 million, the impact on the investors is zero. They're going to get $600 million. So I hope you understand these assets, they can be anything. They can be, initially in the early days of Sukuk, when a decade or so ago, this used a lot of assets, especially issued out of the Middle East and the UAE, these assets were literally sand in the desert. It was literally sand. That's what it was. And then over time, they became a bit more clued up, and so they would actually have real tangible assets with some kind of valuation. But now, often it's financial assets. But it doesn't matter if it was sand. It doesn't matter if it's, I don't know, like furniture in a house. It doesn't matter what it is because they never have any exposure to it. Right? They're always going to get this and their annual return, and they're always going to get this at maturity. So I hope you can see that, the absolute nonsense that we make of assets. So if you own it, you cannot do a single thing with it other than sell the assets at maturity for face value. Right, so yeah, the assets. Investors buy the assets, but not really. You don't buy assets, you buy some beneficial interest or ownership in assets. The investors do not benefit if the assets earn over the expected rate. They do not suffer if the assets earn less than the expected rate. The investors do not gain if the asset price rises. The investors do not suffer if the asset price falls. The investors can do nothing with the assets apart from sell them back at face value at maturity. So what kind of ownership is it? Have you ever seen ownership in assets that strips every single aspect of ownership and risk away from you? But this is exactly what happens in every single Sukuk. So let's talk a bit about AAOIFI. AAOIFI have their, they're the most widely used global Sharia standards. Now, around about a decade ago, 2008, for Sukuk, Justice Taqi Usmani, who's the chairman of the Sharia board of AAOIFI, he's one of the most prominent scholars in the world in Islamic finance. And he's the chairman of the Sharia board at AAOIFI. He said Sukuk, a lot of Sukuk are not Sharia compliant. He said something like 85% are not Sharia compliant because they behave like debt instruments, which is exactly what I've showed you. Investors take no asset risk on face value or on performance. This is what he said. Now, what he outlined, and AAOIFI actually outlined this as well, they changed their standards to accommodate what he said. He said investors should actually buy and own the assets. That's the first thing he said. There should be a true sale. He said investors should benefit from the return actually generated by assets. And if there's a shortfall, they should bear it. The shortfall should not be paid by the obligor. At maturity, the sale of the assets should not be at nominal value. It should be at market value of the assets. And actually, AOFI changed their rules to agree with this. They changed their Sharia standards. It took them 1 or 2 years, but they did it. Now, when Sukuks are issued now, since then, and I've reviewed dozens of Sukuk. I've written a series of books. One of them is on Sukuk, purely on Sukuk, and I'll show you the chapter headings to show you that the volume of different types of Sukuks I've analyzed. And I've reviewed dozens of prospectuses, right? Dozens and dozens. I've never seen one that meets AOFI Sharia standards, right? They all break them. So AOFI Sharia standards try to ensure the investors actually buy the assets, they own the assets, and they get a return based on the asset's performance, and they bear risk on asset price. Not one single Sukuk at all ever does this, right? That's why not one single Sukuk I've ever seen states or dares to claim that it's in compliance with AOFI Sharia standards, because they're not. Right, so this is, yeah, you can't see it, that's fine, but it's just, this is the list of chapters from my book on Sukuk. So the kinds of Sukuk that I've analyzed, so I'll just read some through. Ijara Sukuk, right? Musharaka, Mudaraba Sukuk, Wakala, Murabaha, Project Finance, Perpetual Sukuk, Equity Linked, Exchangeable Sukuk, Hybrid Sukuk. So these are the kinds of Sukuks I've analyzed in detail. And for each one, I analyze markets, transactions, just as I done today through prospectuses. And in every single one, the pattern is exactly the same. 100% the same. Right? There is no difference. No Sukuk behaves in any different way other than what I've shown you. Right, so Sukuk, I mean, is it a big deal? So if I'm just reading some of the, if there's any questions on that. There are quite a few questions. Let me just see if okay, the question is for Sukuk. If the coupon is not fixed but fluctuating and principal is guaranteed, how do you price a Sukuk? So interest can be fixed or floating, right? If a return on a Sukuk is fixed or floating, it makes no difference. Interest is fixed or floating. It's priced according to projections of interest rates. It makes no difference. Riba is riba. Riba is fixed interest is riba, and floating interest is riba. So fixed coupons or floating coupons don't behave any different. It's priced according to bonds. How bonds of Sukuk are priced according to bonds, which are based on effectively discounting all the cash flows to the present value and applying a quantum on the credit risk that's faced, which is the ability to redeem the bonds. Okay, but bonds are priced exactly like Sukuk, but they bear an extra risk to Sukuk, which is to do with Sharia compliance. It's a bit complicated, but they bear an extra risk to Sukuk. For example, Dana Gas Sukuk, which is a couple of years ago, I think. And so it was a large Sukuk, over $1 billion. And at maturity, Dana Gas just refused to redeem the Sukuk. They said it's not Sharia compliant. So this is a risk that all Islamic transactions take, because they said themselves it breaks Sharia rules, and they use this to try to protect themselves from repaying. So this Sharia risk is an extra risk in Sukuk that are not existing in bonds. So the pricing in Sukuk might be slightly different. Would the market work with real Sharia compliance structure sharing of risks? So that's a good question. So why does the market work this way? Why does the Sukuk market works this way? Because the decision was made to replicate bonds. Once you replicate bonds, you must replicate them. You can't mess around, because bond investors will invest in Sukuk. Right? So Sukuk must behave like a bond. So if you were to change Sukuk to behave properly, right? Would investors invest in them? Yes, but different investors. So this already occurs. So for example, what behaves like, if I say you bear the risk of owning something, so, and you have a return based on ownership and a redemption is based on market value. So this is what stocks do, right? This is exactly what stocks do. You get dividends and the price goes up and down. You also have securitization. right? This is a major asset class, and all the risk of the assets are passed to investors. This is precisely what this will follow very good Sharia principles. But if you issue securitization, they are not bonds. It's a different investor class because the capital is not fixed and the return is not fixed. In the bond, you must fix your capital and you must fix your returns in terms of fixed or floating. But it's a different asset class. These are not the same asset class. So Sukuk, the market, I would say, the market has chosen to replicate bonds. So Sukuk, a classic Sukuk will operate like a securitization instrument if they follow good Sharia rules. But the decision has been made to follow bonds, right? So is Sukuk a big deal? Yes, it's a pretty big deal. I mean, this is from AAOIFM, and the total Sukuk issuance from 2001, it's $1.2 trillion, which is quite big, right? And if you look at the last few years, 2020 is not here, but the last few years, it doesn't really fall below $100 million. The average is over $100 billion per year. I mean, 2019 is $145 billion. And most of the last 6 or 8 years, there's only been 1 or 2 where it's been below 1 or 2 years below $100 billion. So this is a big deal. It's a big market, and all of them operate exactly as I've shown you. Right. So I just want to get across here that there's lots of different types of structures. So I showed you the contents from my book, and there's about 8 or 10 different Sukuk structures. So you'll see some here. You have hybrid Sukuk, Murabaha, Mudaraba, Ijara, Murabaha, exchangeable, Ijara, Musharaka, Murabaha, all this stuff, Wakala. They all behave the same way. They all behave exactly as I've shown you. So Sukuk is a big deal. It's a flagship instrument of Islamic finance. It makes fantastic claims about avoiding riba, about risk sharing, about assets, ownership, profit from assets, and profit sharing. All of these claims are false. They break AAOIFI Sharia standards, and it is no different in any meaningful way to a bond and riba. Okay, who's at fault? I mean, everybody involved is at fault, and I've been involved in this. This was my job for a long time, so I don't present myself as being outside of this. I've played a significant role, as much as an individual can, in this market. I'm not free of blame, and I accept that. So I'm not blaming others, I'm blaming Muslims. So who's at fault? Issuers. So issuers, because they raise money knowing this, right? And that's what they want. Investors as well, because Islamic investors, they invest money knowing this. Institutional investors, they invest money in Sukuk knowing this is how it works. The lawyers who draft these agreements, now it doesn't matter if the lawyers are Muslims or not, but the lawyers know what's going on and they're not breaking any rules, right? They're drafting exactly what the parties want. And they're doing, lawyers don't make transactions. Lawyers react to what the parties want, right? So they draft the agreements, but any lawyers involved in drafting these agreements, especially international Sukuk, they know exactly what's going on because the documents have to do, we've looked at the prospectus, how it carefully manipulates everything. So this is through the documentation. It's not by chance. It's very, very carefully organized so that it stands up in a court of law. So lawyers, of course, know what's going on. Islamic banks know what's going on. Of course they do, because they're some of the largest issuers of Sukuk, and they're some of the largest investors in Sukuk. And scholars, this is a sensitive issue. I have as much respect for scholars as anyone, right? But either they know what's going on and they're staying quiet about it because they're paid. Right? I'm talking about the scholars that are getting paid. When you issue a Sukuk, you pay for Sharia compliance, whether it's from the Sharia board of a bank or the arranger, or you create a separate Sharia board. They give their approval to these, and scholars charge. I mean, I've worked on very high profile international Sukuk transactions, right? Large ones. And my job was to speak with the scholars, present the documentation, explain it to them, and get approval. And they were paid for it, which is fine. You can be paid for commercial work, and they were paid a lot. Now, I'm not a banker anymore, but I was a banker, right? At quite a senior level, and alhamdulillah, my salary was good. And I was shocked at how much the scholars were getting paid. But that's okay. They provide a commercial service, and that's fine. But my point is, once you have significant fees being paid for these services, this introduces a massive conflict of interest. Because if a scholar stands up and says, you're actually breaking Sharia rules. What you're doing is replicating riba. I'm not going to approve this document. So what will happen to that scholar? He's not going to get paid. He's going to get kicked off the Sharia boards. So what we're doing to scholars is that we're really manipulating them and saying, if you want to be active in Sharia boards in the Islamic finance industry, especially in banking, you've got to approve these things. If you don't approve them, bye-bye, you're gone, we'll get someone else. So we're putting scholars in an untenable position, but scholars have a role to play. They definitely have part of the blame to lay on them as well as everyone else. And who benefits financially from this happening? Investors, issuers, lawyers, Islamic banks, and scholars. You notice the list is exactly the same, right? So this is a problem we have when the people are responsible for creating this riba. They're also the ones who financially benefit from this, right? So it's very difficult then to find who is responsible for change, who is incentivized to change anything, right? So even AAOIFI, for example, so they have changed their laws a little bit. They've changed their laws, not as much as I would like them to change, but they've not laws, the Sharia standards, but they have no authority. They cannot go to any Sukuk issuer and say, you must follow our Sharia standards. This is why every single Sukuk ignores AAOIFI Sharia standards. So you have Sharia standards that are unenforceable, right? Now, if something is unenforceable, it's practically useless. So it remains in books, right? So, and AAOIFI, they don't benefit financially from this, but they're powerless to stop it, okay? And so what I've shown here is Sukuk. This manipulation of Sharia principles occurs in virtually everything in Islamic finance. Depending on the context that they use in the financial instruments, the nature of manipulation is different. But this manipulation is as direct, as fundamental, and as total as I've shown you. The reason I like Sukuks is because they're public documents, right? I can pull a prospectus and show you exactly how it works. Now, I can't do this with other instruments that Islamic banks use because they don't publish the documentation. But I know the documentation. I mean, it's my job to create the products for Islamic banks. I know exactly how they work. But when I explain how things work, it's different when I can show legal documentation and show this is how it works with evidence, and this is what Sukuk provides. Right, so the process of manipulation. So we begin with very simple Sharia compliant principles. Like in a Sukuk, right? It's very simple that you buy an asset, you get the profit from the asset, and then you sell the asset. You can't get much simpler than that, right? And this is Sukuk, and so, how can you argue with that? But based on what you want to replicate, and in banking, it's always riba, right? It's built on interest. So when you want to replicate something, it's always riba. So when we Oops, I don't want to go. So based on what you want to replicate, now you begin to amend the contract and you amend the principles that you've introduced. You tweak them, you adjust them, and you amend them. So these changes look minor on their own, and they appear to, maintain Sharia compliance for the transaction, but they don't. When you put them together, and like I've shown you, when you put them together and you look at the end result, you're left with riba. You're left with nothing but riba. Right? But Sharia approval is pretty easy. I mean, this was my job, and a lot of people do this. I can get Sharia approval on pretty much anything. And why? I mean, this is a difficult question to ask. Why is it so easy? And the answers to that are painful, right? And people get offended when I say why. But it's easy. So this is why I said I like Sukuk, because it's public documentation. And why they're public? Because these are often they're listed instruments. When an instrument is listed on exchange, the documentation, including the prospectus, has to be presented to the exchange. So it has to be publicly available. That's why I like Sukuk. Everything has a prospectus, and they can't really hide anything in a prospectus. You can hide things in presentations, right? And in teaching, if you're taught something about Islamic finance, it's not a legal risk disclosure document. People who teach Islamic finance don't even understand what's going on. They don't even know what the market does. They just teach principles like the two tables I showed you earlier on, right? By Sukuk versus bonds. This is the kind of nonsense that's taught about Sukuk. I bet if you've received any education in Islamic finance, that's what you've been taught. It's all nonsense. So that's why I like Sukuk. And anyway, the people who know, how things work, there are quite a few people out there. I mean, a lot of people I worked with who are my peers, my equivalents at other banks, either they're too stupid to know, right? Sometimes, but in general, they're intelligent enough to know what's going on. And they all knew, or they all know what's going on. And they just say, what can you do? This is my job. What can I do? I wish it was different, but what can I do? And anyone else who, a lot of people get upset when I say these things. If you follow me on Twitter, I'm quite frank in what I say. But so many people are ignorant. When it comes to Islamic finance, we have an emotional attachment to it because it's Islam, it's our religion, and scholars speak positively about it. So we don't like to be told it's all wrong, right? So, but this gullibility is from our ignorance, right? I mean, we really are being misled. So what's the way forward? I mean, I really don't know, but these are some ideas from me. Muslims should educate themselves as to really what's going on. But it's not easy to educate yourself because nobody will talk about these things. I mean, I talk about them as openly as I can, but I'm not very good at, all this marketing stuff and arranging, propagation and marketing I really, it's not my stuff. But, I just try to educate people in my own small way that I can, but we need it to be much more organized. Um, and there's too much propaganda from Islamic finance industry. There's not, from teachers and professionals, people who teach, they're not the way forward because they don't even know what's going on. They don't even understand the reality behind the products. All you're taught is the theory. That sounds fantastic. That sounds, it's in line with our religion, and we feel fantastic and we feel powerful when we hear of a successful Islamic finance industry. And everybody, it's just propaganda, but we're emotionally attached to it. But somehow we must spread this knowledge. Knowledge is power, real knowledge, and then push for change. Common people can force change. There's no doubt about that. I mean, I have no doubt a common person can force change in Islamic finance if there's a will to do it. So it's sort of about organizing efforts and spreading the word. Sukuk is a good place to start because it's public. Nobody can argue with a Sukuk because the prospectus is black and white. Now, everybody can argue with other things. When I talk about how things work in Islamic finance, people can argue with them because in general, I don't have contracts to show them. I can just explain how it works, and people can say, no, that's not how it works. And it's hard to show them black and white evidence unless you have contracts, but with Sukuk you can. So yeah, that's the end. Let me just see if there's any final question. I know it's gone a lot longer than we thought, but that's the way it is. Let me just see if there's any more questions that I can address. You don't really own the underlying asset. That's correct. Similar with derivative instruments. Yeah, Sukuk is comprised of derivatives. So what are there are many derivative elements in a Sukuk, right? Let me try and get a slightly, it's not thick, okay. So Sukuk has got many derivative elements. So the first of all, you have the coupon, right? So the coupon has to be transformed from something that looks like it's from the asset into a guaranteed coupon. In this case, it's 1.8. Now, 1.81%, right? This transformation is a derivative. It's like a total return swap. They're taking the return of the assets and they are converting it to a guaranteed 1.81%. This is like a total return swap. That's the first derivative. The second derivative is the use of the two undertakings, the purchase undertaking and the sale undertaking. This is a derivative, and this is the creation of a forward. But it's the creation of a synthetic forward, right? By effectively using, put and call options. This is what they are. These are put and call options. And you can create a synthetic forward using put and call options. So this is a clear derivative. So Sukuk has derivatives because why? Because on the face of it, the risks are to do with assets, on the face of it. So, but they want to transform this to riba, right? So to transform it, they use derivatives. That's exactly what they use. Okay, what's another question? What's the name of my Sukuk book? Gosh, okay. I'm not here to market my book. I don't really, I've published books and I don't really care about them. I never market them, but I did mention it, right? So they're on Amazon, but I prefer you to buy them from my website because Amazon takes a ton load of commission, right? So I prefer you to buy it from my website, which is safraalam.com. Yeah, excuse my writing. I know it's rubbish, but there you go. Saffron.com. There's a book section on there somewhere, and I have 3 books, and the second one is on Sukuk, and it's available. I think this it's ebook. I think if on my website you can get ebook. If you want a paperback, then you can go to Amazon. For paperback, you can go to Amazon, but for an ebook, you're better. I don't know if the price. I think the price is the same. I might have changed them. I don't even know. I might have put the price up on my website. I don't know. So look at Amazon and look at my website. Just choose whatever you want. If you want it, yeah. If you want it, whatever. Okay. Next comments. In conclusion, you don't really. It's okay. The Sharia violating factor that you highlight can we screen and abolish them all? Can we say the notion of Sukuk should be embraced as soon as Sharia, as soon as the breaches have been resolved? Yeah, we can abolish them, right? But who's going to abolish them? You know, I highlighted who's responsible for it. The same people responsible for it are the ones who are in control, who have the power. So the only way, I mean, in my view, there's um, 2 clear ways to abolish it. One is from scholars taking a strong view. Now, the good thing is there's a whole bunch of scholars who are outside of Islamic banking, right? Those scholars generally are more open about their views. There are many scholars who speak against exactly the kind of thing that I've showed you. But they're not advising Sharia banks because they would get the sack. But there are many scholars who understand to some extent the reality of what's going on. But how do you abolish them? It's a monster of an industry. I've shown you over $1 trillion Sukuk have been um, issued this way. And it's across all of Islamic banking, the deposits, the savings accounts, the personal finance, the car finance, the home finance, credit cards. Everything's built on riba in Islamic banking. So how are we going to change that? You know, it's difficult to change the established power, but scholars can do it. There's no doubt. Scholars can do it, but you know, to be blunt, scholars are busy getting paid to approve these things. So while they're getting paid to approve these things, it's very difficult to see the same scholars standing up and asking for change. This is the reality of it. They're in a conflict of interest. Oh, thank you. Someone's put a link to my website already. Fantastic. What then is beneficial ownership? I have no idea. I've spoken to lawyers a lot about this thing, and I speak to lawyers who draft these documents, not to general lawyers, and they explain things to me. And in general, you know, I would say my intelligence and understanding is moderate or above average, and I still do not understand what they say about beneficial ownership. It's a complete joke to me. I have no idea. How come not a single real Sukuk exists? Because they don't want it to exist. A market exists for investors who understand this and will not bear the guilt. I, I don't know. I mean, there's a market for investors who want real risk, and that's securitization, right? That exists. It's very Islamic, but it's not like halal securitization. Securitization as an asset class is quite big. It already exists, but but they pay interest on it because it's not halal. But you can, it's exactly the same as, you know, what a proper sukuk should be. But they don't exist because the market doesn't want it to exist. The Islamic finance industry does not want genuine sukuk to exist. So it's difficult to make it exist. Is buying a share in a company riba with riba considered as halal? You know, when you buy shares, there are Sharia standards for screening of shares. AOFI have some, but there's 3 or 4 or 5 now. Dow Jones have their screening in indices, so they analyze the level of permissibility and impermissible activities, and also the debt ratios. So it's something that you can Google. Do you have theoretical pricing for real sukuk? If a market, yeah, securitization. Securitization is already exists to price sukuk. It's not difficult to price variable cash flows according to market risks. It's done all the time. I mean, how do you think companies are priced? How do you think shares are priced? In theory, it's pricing all the well, it's trying to model all future cash flows for a stock owner, which is dividend, right? Which is often a portion of the earnings. So they're trying to model future profits and discount them to current value. And when you discount future dividends, in theory, this is the stock price. So I mean, the model of pricing already exists. It's not simple, right? But it already exists. It's a growing, okay, the refutations, okay, it's a growing industry. But you know, I've been active in Islamic banking for 20 years. When 20 years ago, people were saying it's only 20 or 30 years old. Islamic banking started in 1971 or so. So it's 50 years now. And now we have, you know, so it's 50 years, right? 50 years is not young anymore, right? 50 years plus. This is not young. But so when I was in Islamic banking, we had about $100 billion in assets, right? And I remember when it reached 200 billion, it was like a big fanfare. This is a massive thing for us. Now the value is around about 4 trillion, right? So you're telling me, no, I know you're not telling me who wrote it, but this is a refutation of saying that it's a young industry that you can change. But from this growth from 1 billion to 4 trillion, nothing's changed, right? This was completely built on interest. It's still completely built on interest. So we've grown by $3.9 trillion. And 99% of this, I've done some analysis, 99% of this is absolute riba. So how can, if it is a young industry, but you'd expect the marginal growth to be moving away from riba, but it's not. And how many Islamic banks do we have now? We must have 500 plus Islamic banks, right? And I've shown you with the Sukuks, the amount of Sukuk issued, right? Not live at the moment, but issued since inception, it's $1.2 trillion. This is quite a lot. At what stage do we say this is, um, not young? It's and there's no intention for change. I spent a lot of time speaking to people in the industry and scholars say this needs to be changed, and nobody wants to change. There's no need for change because everybody is being incentivized to accept this. So, what's my solution apart from criticism? Yeah, I really don't like that question. What's your solution apart from criticism? you know, yeah, I really take exception to your tone here because this is not criticism. This is highlighting the reality. If you see it as, I mean, the reality is criticism. It's not me that's criticizing it. It's the reality that's criticizing it. And I'm showing reality, right? What the solution is, yeah, okay. So this is a question I get. So like I said to you, we have 500 Islamic banks. We have $4 trillion industry. We have $1.2 trillion issued in Sukuk, and we have me, SAFTA. I mean, there's nobody else I know that speaks openly about these things who knows what they're talking about. And you want me to fight this industry, and what's my solution, right? SAFTA, what's your solution? Do you think, you know, I'm going to solve this industry? This industry does not need solving. This industry it's a living being, right? How can I solve it? It's I'm sorry, but it's a stupid question. It's a question for somebody who doesn't want to accept what I'm saying. What I'm saying is that this is absolutely wrong and it needs to change. What's my solution? I mean, what do you want me to do? I've established an Islamic digital bank, right? And it's going to be launched in the UK. What do you want me to do? I really don't know. But I'm trying to educate people. I mean, the idea is that I educate people who are smarter than me, right? I want to tell people who are more intelligent than me, who've got more ability to change things than me, who are better resourced than me, who have better contacts than me and better networks than me, that they can perhaps take some steps to enforce change, right? I mean, what am I going to do? I'm just one guy sitting at home. Yeah. So, and we're all Muslims, right? I'm not the only Muslim here. Why is Islamic finance my responsibility? Why is it not Muslims' responsibility? Okay, no problem. It's very deep to discuss. I mean, the problem is we Muslims have sold out to riba. Islamic finance is built on riba, and this was the intention from the beginning. It's a financial problem. It's greed, and it's lack of fear of Allah. These are the two things. Are we getting the recorded audio and slides? It's being recorded. Yeah. I mean, I'm not sure whether I will make it public. I'm not sure. I'll think about it. I don't know. I mean, to be honest, one of the main things it's a hassle for me to edit it and make it public and put it on YouTube. I have a YouTube channel, but I don't post anything to it, to be honest. I mean, it is being recorded, but I don't know if there's anybody there who can help me with the editing. And I mean, I do my own editing, and to be honest, I can't be bothered half the time. Maybe I'll put it up. I'm not sure. Um, Another argument, right? There's nothing wrong by economic substance. When Bismillah is said, it becomes halal. Yeah, no need to judge the economic substance, right? This is an argument that really makes me angry. This is an argument made of ignorance to say that, as long as you follow the right process, then then it's Sharia compliant. But my point is this, right? My point is that when the outcome is riba, and you're ever replicating riba, that you cannot have a process that is clear and halal. You cannot. In the process, you're going to have things that are dishonest. This is my whole point in the process. The point is that you don't know where the dishonesty is. Now, I've shown you in these things that they're doing, underhand. Would I call it underhand? No, I mean, it's transparent because it's in the documentation. But you got to look at your intention. If I do something and I try my best to avoid riba and it ends up having some riba, then I can say I'll try to fix it. But when you have, how many times can when you have a $4 trillion industry built on this, then you've got to reach the point to say that riba is not just a consequence of what they're doing, right? Riba is the whole aim of what they're doing. They would not do it unless they could deliver riba. So to say that the following um, the technical process of Sharia and the outcome just happens to riba, I mean, this is an argument of absolute ignorance, and I've got no time for it. Islamic finance has to grow to get attention from the market. When they grow, it's going to create its own environment, mean benchmark. Now, this is all propaganda. This is all propaganda. I'll tell you what. I mean, how can I illustrate this? So many years ago, I've been ranting and raving for a long time. Many years ago, I came up with a project, which is a realistic project, and I presented it to Islamic banks to how to change their whole funding basis, right, to try to avoid riba. And I presented it to a whole bunch of Islamic banks, and unilaterally, every single time, the answer was no, we're not going to do it. We're happy with what we're doing. So, the idea that Islamic banks want to change, I've seen no evidence of this. And an Islamic benchmark, this benchmark, again, it's a benchmark for what? It's interest. When you give money and you want more money back, they want a benchmark for that. It's interest. It already exists. And if you're investing and getting returns, you don't need a benchmark. You just take the returns. The Islamic benchmark is one of the biggest myths produced. There's no need for a benchmark. It's a unicorn. It doesn't exist. The contractual agreements, they make Islamic finance look like conventional by doing some sort of Sharia manipulation. They do, and this manipulation is in every single form of Islamic banking. There's nothing meaningful that exists that's not manipulated to look like riba. So I do more open source discussions. Yeah, the thing is, I do like to educate and share and discuss and debate, but I don't have the time to create a platform for myself and for others. It's to arrange this thing, right? It's on Zoom, and I had to, I put it on my website, and I did a registration, and I sent a couple of emails, and I had to put it on Twitter a few times. Please join this webinar. I really don't like doing that stuff. I'd like to just turn up and present or talk. I just want to do that. It's not for me, all this arranging and marketing and positioning and platform. I really haven't got the energy to do that. So if any of you are here and you want to help me with that, it will be very welcome. Yeah, you make a good point about difficult to articulate sound critique of the industry and practices. With your expertise and knowledge, I think you're uniquely positioned to fill this information gap. And you're right. I mean, I'll tell you what I feel. I feel more than anything, I feel an obligation on me to try to spread what I know. But I need better ways to spread my knowledge, because I just do the odd webinar here or there, and this is, really, I'm being honest. If any of you want to help me to be able to spread my message in a much better way, the way I spread it is rubbish, I know. But if you want to help me to spread it in a much better organized and intelligent way, I really would welcome you to get in touch with me and help me. I just do what I can. Okay, any data releasing of NIA? Yeah, very soon. So NIA is the digital Islamic. It's not a bank because banks are involved with riba, but it's an application. It's a banking application. Yeah, okay, it's regulated. Yeah, the release of NIA. Yeah, I mean, it's what can I say? Yeah, I mean, you might have heard that there's been an acquisition by Wahed Invest, the Wahed Group. And that's really accelerating things, and it's going to be a really significant launch very shortly. What do I do for a living now? I'm self-employed. I do some lecturing and teaching on Islamic finance. I've written some books. I do some consultancy. Um, I'm involved in Islamic, I guess you call it fintech now. So Nia was the first project I've worked on. It's been acquired now. I'll continue to work on that. But I'm looking at building a couple of other projects to one on SME financing and creating a new asset class, which is away from riba, to help Islamic banks to get away from riba, and another to do with fintech on the, I mean, loosely it's on the crypto side, but not really crypto, on the maybe on the blockchain and excuse me, on DeFi and decentralized finance. Those are two projects that I'm working on because these have a big impact to help Muslims and to change Islamic finance. If you can help me with editing, that's fantastic. But if you could, I don't know how you. I only put this on Twitter, so if you so please drop me a DM on Twitter if you have any skills that you can help me with or time. Please send me a DM on Twitter, and I'll get back to you. So I really appreciate your offers. Thank you very much. One of my lectures stated you work with the banking regulations. You're tied down to riba. You're right. Once you have a banking license, you are absolutely tied down in what you do. So the first mistake Islamic finance has made was to establish themselves as banks. You cannot be a bank and be Islamic. It's a complete nonsense. So you might ask, well, why haven't I worked at Nia as a bank? So Nia, in theory, it's not going to get a banking license because it's not going to work on the basis of giving credit and charging interest. So you don't need a banking license to do what Islam and Sharia demands. But once you get a banking license, then you can say, well, I have to do this, I have to do this. It's nonsense. You just don't need a banking license. One of the biggest mistakes Islam has made, not Islam, Islamic banking has made, was to try to establish Sharia economics through the mechanism of banks. It's an absolute disaster from the start. I've tried to set up a digital bank part. My people are not ready. I think they will be ready if there's enough credibility in the market. I mean, digital banks in Europe, there's no credibility because even Islamic banks, there's no credibility because nobody's done it in any meaningful way. But I think there's potential for it to be done. Yes, Assam. So thank you for you put your details on there. That looks like a UK mobile. So yeah, I mean, please drop me a DM on Twitter or contact me on my website, please. Okay. Am I working with Ali? Yeah, Ali Abdulkader. He's the CEO of Nia. Yeah, and I'm a co-founder with him and a small group of us. How can I contact you for consultation? Through my website. There's a contact box somewhere there, or DM me on Twitter. That's probably the easiest way. Islamic finance suffering from wrong model of implementation. What's the better model? I mean, so this is the last question. I know we've gone on for a long time. Wow, 2 hours. Okay, so crypto, blockchain. So I started talking and researching about Bitcoin. So I like Bitcoin because it has certain characteristics that make it difficult to implement riba. I don't really care that it's Bitcoin. I don't care about Bitcoin, but some of the mechanisms, the technical mechanisms of its creation mean that it can oppose riba much more effectively than fiat money. And that's what I like about it. To the extent that blockchain is involved with that, I like it. But otherwise, crypto in general, I really don't know much of the benefits of it apart from avoiding riba. But in the crypto space, there's so many dodgy things going on that are not halal. That's so much speculation. It's like a shark-infested pool out there. But I think in the general area of fintech and blockchain, and perhaps crypto, there are real solutions that can and decentralized finance, DeFi. There's real solutions out there for Muslims. That's one of the projects that I'm looking at. So thank you guys. Thank you very much for attending. Thank you very much for your patience. I've gone on a lot longer than I intended. Yeah, thank you very much. So if you have anything that you wish to contact me, or, I've asked for help in quite a few different areas. If you're willing to help, please drop me a line on my website. There's a contact, or on Twitter, you can DM me, or just, yeah, do whatever. So thank you for attending. For those of you who attended and stayed, thank you. Thank you for your patience. I hope you learned something here. Um, yeah, I've enjoyed it. Thank you for your time, and assalamu alaikum.